Fair value gaps are powerful trading zones that often cause the price to react, offering us great trading opportunities. However, if you trade every fair value gap you spot on the chart, you'll probably end up losing money. So what makes an FVG high quality and worth trading? To answer this question, we've backtested over 100 fair value gaps on the recent euro-dollar chart to uncover the exact characteristics of those FVGs that actually move the market. In this video, we'll explain how to trade FVGs like a professional trader. Also, how can they be combined with other smart money concepts to enter high-probability trades? So guys, if that's something you're interested in, as always, smash the like button to support us in making more videos like this, and subscribe if you're new. Starting with the basics. What are fair value gaps, truly? A fair value gap, or FVG, is a price gap caused by a sudden imbalance between the strength of buyers and sellers. It's defined by a three-candlestick formation, where we have a gap between the wicks of 3 consecutive candles like this. Now, what does the fair value gap even mean in terms of price action? As the name suggests, it simply means that there is a gap between the fair value of the price. The massive buying pressure has caused this aggressive movement, likely due to institutional activities, and now the price is inefficient. But what is the purpose of marking FVGs on the chart? These gaps represent inefficiency in price movement, meaning the market may later return to fill them as the price seeks equilibrium. Additionally, traders often use these gaps as key areas of interest, anticipating potential price reactions when the market revisits them. Here on the euro-dollar 15-minute chart, notice how many times the price returned to the fair value gaps before continuing in the same bullish trend. This repeated retest of the zone suggests that the market is filling the imbalance before resuming its upward movement. Here on the pound-dollar 1-hour chart, the price returns to mitigate the bearish FVG created during the Asian session and then continues pushing downward. This rejection shows that the FVG acts as a supply area where the selling orders are located. When identifying these gaps, you have noticed that they come in different sizes. So here comes a question. Do larger fair value gaps act as stronger supply or demand zones? Not necessarily. While larger fair value gaps might look more significant on the chart, size alone doesn't determine their strength as supply or demand zones. Here's why. Larger FVGs often occur during periods of high volatility, like news releases or institutional moves. They can indicate strong momentum, but they might also be filled quickly and not hold as key reversal zones. Smaller, more precise FVGs, especially when aligned with other smart money concepts like liquidity grabs, break of market structure, or market direction, often lead to more reliable and cleaner reactions. So, while size can give you a clue about volatility, confluence is king when it comes to trading FVGs effectively. Now here comes the main question. What makes an FVG high quality and worth trading? Fair value gaps work best when they align with market structure conditions. When you combine them with key elements of SMC, they become powerful entry points with real precision. To identify high-quality fair value gaps, you need to focus on 3 key factors: market direction, liquidity, and the retracement levels. When these align with an FVG, that's where the real high-probability trades happen. So let me break down these 3 important concepts for you. Market direction. Who is in control? From the basic price action, we know that in a perfect trending scenario, the market makes higher highs and higher lows. Each time the price breaks above a structure level, it signals trend continuation, and a demand level automatically forms. Conversely, when it breaks below a structure, it signals a possible trend reversal. But the important thing you must keep in mind is the fractal nature of the market. Now, what does the fractal mean? It means that this uptrend formation can just be a correction in a higher time frame. So now that the price has tapped into a higher time frame supply zone, it has the power to change the direction in the lower time frame. Now we have a fight between supply and demand, and there is a high chance that the higher time frame will dominate and push the price lower. Once again, this could also be a correction on an even higher time frame, and the pattern may continue. That's why we always need to check higher time frames to identify market structure conditions within the bigger picture. It's common for traders to combine 2 or more time frames to make well-informed trading decisions. So let me show you how to perform a proper top-down analysis using a real chart example. In this example, we're going to use the 1-hour chart as our higher time frame and the 5-minute chart for entries. On the 1-hour chart, we'll simply analyze the market direction and identify fair value gaps. Then, we'll zoom into the 5-minute chart to look for confirmation and enter the trade. Looking at the Euro-Dollar 1-hour chart, the price is in a clear downtrend. The recent move was an aggressive push to the downside with strong bearish momentum. So, at this point, the higher time frame direction is bearish, and we only want to look for selling opportunities. However, we can't enter the market just yet, because the price could correct at any moment. We need to wait for a pullback to enter at a better price. But the question is, where? If we focus on the latest impulsive move, we can see that it created a fair value gap, which becomes our optimal trading zone. If the price retraces to this gap, it could offer a strong opportunity to go short. However, we need more confirmation, because reversing exactly from that zone is not guaranteed. The price could easily retrace deeper and cause a loss. So first, wait to see if the price corrects back into the zone. Then zoom into a lower time frame to find confirmation and execute the trade. Since the analysis time frame is 1 hour, we can use either the 15-minute or 5-minute chart for execution. But for now, let's zoom into the 5-minute chart for more detail. Here, we already know that our higher time frame structure is bearish, so we want to find a reason to enter a short position. However, the lower time frame structure is currently bullish, so for entry, we need 2 things. A market structure shift to confirm alignment with the higher time frame direction. A solid entry reason to set our sell order. Now let's see what happens next. The market has made a strong push to the downside, breaking below the trend line and this demand zone. It has also formed fair value gaps, which reflect continued bearish momentum. We can take this move as a signal of a market structure shift and additionally an entry reason to go short. So this is how we execute the trade. We place a sell limit order at the beginning of the higher FVG zone and set our stop loss above the swing high to protect against market fluctuations. I'll explain later in the video why we didn't choose the lower FVG. For the target, we can aim for the unmitigated fair value gap ahead of the current price, which gives us a trade with a risk-to-reward ratio of more than 1:2. Now that we've discussed market direction and structure, let's move on to another key factor that can significantly improve the success rate of fair value gaps: liquidity. But before we continue, if you need more capital for your trades, Markets.com just launched a welcome bonus that's worth checking out. Sign up in minutes and get $5 free, no deposit needed. Verify your ID for another $5. Deposit to unlock up to $1,000 more, and get $10 extra after your first trade. Check the link in the description and claim your bonus today. Liquidity plays a major role in price movements. From the basic price action, we know that the market needs to collect enough liquidity before initiating the next impulsive move. This is why retracements often continue downward until they reach a price where sufficient liquidity is available. Then the next impulsive move forms. This liquidity typically exists below recent swing lows and swing highs. So in this part of the video, we will explain 2 of the trading models that combine the concept of liquidity with a fair value gap entry. We call the first one the post-hunt entry model. Has it ever happened to you that the market moved exactly as you predicted, but only after hitting your stop loss? That's what this model is all about. Imagine you've identified a strong trading zone to go long, aligned with the overall bullish trend. You open a buy position in that area and place your stop loss just below the zone. The price will continue pushing higher, but only if there's enough liquidity in the market. Otherwise, the price might create equal lows and build a liquidity pool below the swing low. Breaking below these lows allows the market to access the required liquidity. Smart money typically hunts these stop losses first, gathering enough liquidity for the next impulsive move to begin. But how do we use this concept to enter a trade? The rules of this trading model are simple. In a bullish scenario, wait for the price to form a low or group of lows and build up liquidity. Then, we need the price to break through the support, engage the liquidity, and quickly return above the level. Now here comes the interesting part. We zoom 2 timeframes lower to analyze the price action and enter a trade. We wait for the price to form fair value gaps and use them as entry points to go long. This is how the post-hunt entry model actually works. This trading model combines the concepts of market direction and liquidity with a fair value gap entry. So, let's take a look at a real chart example. Here we have the euro-dollar on the 1-hour chart. Recently, we had an aggressive push to the downside. If we want to trade with the trend, we need to be patient and wait for a pullback to get in at a better price. A perfect trading zone would be this green candle, the one that initiated the most recent drop. So we mark this area and set a sell limit order, waiting for a correction. If the price retraces all the way back to this zone, it will give us a clean entry for the next downward movement. So let's set up the trade and wait for the result. In the following hours, we only had small movements on the euro-dollar pair due to the low trading volume during the Asian session. But watch what happens when the London session begins. First, the price breaks above the swing high, engages liquidity, but quickly returns inside the range. It completely closes back below the supply area after hitting the stop loss. Now that the market has gathered enough liquidity, it could be the time for the price to continue pushing down and resume the downtrend. So let's zoom into the 15-minute chart to execute a short trade. On the 15-minute chart, we can observe more details. But the question is, where should we place our sell order? If we focus on the recent move, we can see that it has created a fair value gap, our optimal trading zone to go short. So, we set a sell limit at this zone and target a solid 1-to-2 risk-to-reward ratio. This is an example of how the post-hunt entry model helps us catch high-probability setups by combining the liquidity concept with fair value gap entry. Now let's move on to the next entry model that combines the same concepts. The turtle soup setup. Turtle soup trading setup is another powerful model that combines the concept of market direction, liquidity, with a fair value gap entry. A high-probability bullish turtle soup setup occurs when price sweeps liquidity below a recent low or a group of lows while resting above a bullish fair value gap. Similarly, a bearish turtle soup occurs when price sweeps liquidity above a recent high or a group of highs while resting below a bearish fair value gap. The psychology behind this setup is the same as the post-hunt entry model. Imagine the market is in a clear uptrend. If smart money wants to buy this asset, they need sellers in the market. In other words, they need liquidity. But where does liquidity exist? Liquidity is found below every swing low and above every swing high. The traders who entered long at these levels have their stop losses placed below the swing lows. Each time the price returns to these areas, new orders accumulate, and therefore stop losses. If price collects enough liquidity, it will have the momentum to move higher. Now things get interesting when a fair value gap exists just below this liquidity pool. This creates a high probability trade opportunity in this area. Since liquidity is resting below the support level, there is a strong chance that the price will break below the support, sweep liquidity, and then reject the fair value gap to the upside. Once this rejection occurs, price is likely to gain bullish momentum, push higher, and continue the uptrend. This setup provides a smart way to trade with the trend while using liquidity and fair value gaps to identify precise entry points. Here on the pound-yen 5-minute chart, we see a clear uptrend. Normally, breaking below the recent low signals a market structure shift to the downside. However, if you check the left-hand side, you'll notice an FVG area just below the swing low. This increases the likelihood of price tapping into the liquidity below the recent low before continuing upward from the fair value gap. Once again, notice how price builds a liquidity pool right above the FVG. The conditions are set for price to engage sell-side liquidity, reject the FVG, and push higher. Of course, this doesn't work every time, however. The turtle soup strategy can take advantage of false breakouts and profit from price reversing back in the trend. Now let's move on to another concept that can significantly improve the success rate of fair value gaps: retracement levels. Not every fair value gap you see on the chart is ideal for trading. When multiple FVGs are created during a strong move, the ones forming below the 50% Fibonacci retracement level are usually the most reliable. This area, often called the discount zone, suggests that the price has pulled back enough to offer a high probability entry point. We always want to buy at the discount zone for multiple reasons, including a better risk-to-reward ratio, safer stop-loss placement, and reducing the chances of getting caught in a liquidity grab. Buying in the discount zone means you're entering at a lower price, so your potential reward is much bigger compared to your risk. This way, even if you risk a small amount, the profit you can make is much higher. When you buy lower in the correction, you can place your stop-loss safely below the impulse wave's low. This gives your trade more room to breathe and protects you from normal market fluctuations. Entering at deeper retracement levels helps you avoid areas where the market often makes quick moves to hit stop-loss orders. This lowers the risk of getting stopped out before the real move happens. A similar concept applies to a bearish scenario. In a bearish market, we always want to sell at the premium zone, which is above the 50% Fibonacci retracement level. Selling at a premium gives us a better risk-to-reward ratio, a safer stop-loss placement above the impulse high, and reduces the chances of getting caught in a liquidity grab. Just like buying at a discount, selling at a premium means we are entering at a better price with less risk and more reward potential. With all being said, when a single bearish impulsive move creates multiple FVGs, we should prioritize those above the 50% Fibonacci retracement level to increase the success rate. Trading isn't about predicting every move, it's about waiting for the right opportunity and managing your risk when it comes. Focus on high-quality setups, stay patient, and let the market come to you. So guys, that's it for today. If you found this helpful, thanks for liking the video and subscribing to our channel. See you in the next one.